As of this exact moment, Supermicro Computer Inc., trading under the ticker symbol SMCI, is changing hands at $34.38 per share, down approximately 1.81% on the intraday session. We are seeing significant volatility right out of the gate, with the stock oscillating between a low of $34.18 and a high of $35.02 in just the first few hours of trading. The volume is already surging past 2 million shares, indicating that the battleground between institutional capitulation and deep value retail buying is heating up. If you are watching your screen right now, you are seeing a chart that looks less like a standard equity curve and more like a heart monitor during a cardiac event. The market is pricing in absolute fear, but the price action suggests a massive divergence between the terminal narrative and the actual order flow. This brings us immediately to the tension that is defining this stock. The expectation right now, if you read the headlines or listen to the average commentator, is that Supermicro Computer is on the verge of a catastrophic delisting, effectively becoming uninvestable. The prevailing sentiment is that where there is smoke, there is a fire so large it will burn the entire equity value to zero. That is the expectation. But here is the reality that forces us to pause. Despite the auditor resignations, the delayed filings, and the terrifying headlines, the company is still physically shipping more AI servers than almost anyone else on the planet. The reality is that the underlying business of selling the picks and shovels for the AI gold rush hasn't stopped, even if the accountants have. This disconnect between a broken stock and a functioning revenue-generating business creates one of the most dangerous yet potentially lucrative setups we have seen in the hardware sector in years. We are not just looking at a stock chart, we are looking at a binary event in real time. To understand why SMCI is trading at $34.38 today instead of the triple digits it commanded previously, we have to look closely at the recent catastrophic timeline. The primary driver of this downside momentum isn't a slowdown in AI demand, it is entirely a crisis of confidence in governance. When Ernst & Young resigned as the company's auditor, they didn't just leave, they left with a noisy resignation, stating they were unwilling to be associated with the financial statements prepared by management. In the world of corporate finance, that is the equivalent of a nuclear alarm. This singular event triggered the massive sell-off that we are still digesting today. Investors using platforms like Fidelity or Schwab Intelligent Portfolios likely saw alerts flashing red as institutional algorithms dumped the stock immediately to avoid compliance risks. When an auditor walks away, the trust premium of a stock evaporates instantly, and that is exactly what wiped out billions in market cap in a matter of days. But we need to analyze what is happening today on the tape. The price is hovering in the mid-30s, which many technical analysts view as a critical support zone. If you're trading this on Interactive Brokers, you might notice that the borrowing costs for shorting the stock have remained elevated, signaling that the short trade is crowded. This creates a coiled spring dynamic. If the company announces a new auditor or a resolution to their filing delays, the short squeeze could be violent. Conversely, if the Nasdaq delisting proceeds without a cure period, the liquidity could dry up, forcing the stock to the OTC markets, the pink sheets, where institutional money cannot follow. This is why you see such erratic movement intraday. It is a war between those betting on a fix and those betting on fraud. Let's challenge the common narrative that SMCI is finished. The bear case is easy to make. Delayed 10K filings and auditor resignations usually precede massive restatements of revenue. But the contrarian view, the smart friend over coffee perspective, asks a different question. Is the product fraudulent or is the paperwork messy? There's a massive difference. Supermicro Computer is not a vaporware company. They have tangible assets, factories, and inventory that are critical to the deployment of NVIDIA's Blackwell chips. Unlike a software company that can fabricate user numbers, SMCI has to physically build and ship heavy, liquid-cooled server racks. If the revenue recognition issues are about when a sale is booked rather than if a sale exists, the stock at $34.38 is trading at a valuation that implies the company will never make a profit again. If they simply hire a new auditor and file their backlogged reports, even with a penalty, the stock could fundamentally re-rate overnight. This asymmetry is what is attracting high-risk capital. Speaking of risk, I want to take a moment to ask you about your own position in this chaos. Comment below how many shares of Supermicro you currently hold and at what average price. Are you underwater and holding for a recovery, or did you buy the dip recently hoping for a bounce? I want to see where the community sentiment actually lies. Now let's step back and look at the business itself, because amidst the accounting noise, people forget what SMCI actually does. They are essentially the high-end architects of the data center. While NVIDIA stock gets all the glory for the chips, those chips produce an immense amount of heat. You can't just plug a Blackwell GPU into a standard server rack, it would melt. Supermicro specializes in direct liquid cooling, DLC technology. They build the Lego blocks of the AI infrastructure. Customizable, modular server racks that can handle the thermal load of modern AI computing. This is a legitimate moat. Their relationship with NVIDIA has historically been their biggest asset, allowing them to get chips faster than competitors like Dell or HPE Enterprise. The business model is low-margin, high-volume hardware sales. They don't have the 80% gross margins of a software company. They operate on razor-thin margins, often below 15%, which makes efficient capital management crucial. This is precisely why the accounting issues are so sensitive. When your margins are thin, every decimal point in the ledger matters. The recent price action on Robinhood stock and SoFi Invest shows a surge in retail interest, likely driven by the too-big-to-fail fallacy. But be careful. SMCI is not a bank. It can fail. The comparison often made is to companies like Enron or Wirecard, but a fairer comparison might be to companies that had accounting scandals but survived, like Waste Management in the late 1990s. The difference is the underlying asset value. SMCI has physical inventory that is in high demand. If you're using Fidelity ETFs or Fidelity mutual funds, you might have indirect exposure to this volatility without even realizing it, as SMCI was previously included in major indexes like the S&P 500 and the Russell 2000 before its market cap imploded. The removal or threat of removal from these indexes forces passive funds to sell, creating forced selling pressure that has nothing to do with the company's fundamentals and everything to do with index rules. This forced selling often creates the bottom, as price becomes disconnected from value. Let's discuss the macro environment affecting the stock today. The semiconductor sector is currently in a state of flux. While Tesla stock and Apple stock are battling for AI supremacy on the software and consumer device front, the infrastructure build-out is still in the early innings. The hyperscalers, Amazon, Google, Microsoft, are spending billions on CapEx. SMCI is a direct beneficiary of this spend. If the accounting issues are resolved, the macro tailwinds are still at their back, but the governance discount is currently overpowering the macro tailwinds. It doesn't matter if the sector is booming if investors can't trust the numbers you publish. This is why we see such a disconnect between SMCI's stock performance and the performance of the Philadelphia Semiconductor Index, the SOX. Traders using interactive brokers or fidelity trading platforms are seeing elevated implied volatility on SMCI options. The premiums are sky high because the market is expecting a massive move, either up or down. A straddle strategy implies that the market doesn't know the direction, only that the move will be violent. This is consistent with the binary outcome thesis. The next catalyst to watch is the NASDAQ hearing or any press release regarding a new auditor. If they announce a Big Four auditor has taken the account, the stock likely doubles from these levels. If they announce they are unable to find an auditor, the stock likely halves again. It is that simple. For those of you involved in self-investing or managing a Schwab Intelligent portfolio, the lesson here is about idiosyncratic risk. This is risk specific to a single company that cannot be diversified away by just buying the sector. You could be bullish on AI, bullish on chips, and bullish on data centers,